Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Alicia Levine of BNY Wealth saying the administration's Let's Make a Deal show removes the worst-case tariff scenario. The market can only inflect higher with a policy response. There will be equity vol as long as there is policy uncertainty. Alicia joins us for more. Alicia, good morning.
Good morning.
There's certainly a lot of that going around.
Yeah.
Are we addressing any of this?
Look, I think, as I've said, time is not on the market side and time is not on the real economy side. The longer this gets drawn out, you're doing real damage as corporations and individuals are sort of frozen in place, waiting for what the actual policy is. So the interesting thing about the 90-day pause and the recategorization of some of the electronic tariffs is that it does remove some of the left tail risk in the market, but it doesn't really remove the left tail risk in the real economy, which is getting damaged every day. So at first we were optimistic on that 90-day pause like everybody else, and then when you start thinking about what this actually means, it means it's going to go on for much longer. So Q1's going to come in fine. You had pre-buying before tariffs, and the hard data, as we've talked about, has held up fairly well. The soft data is rock bottom, and again, where can this go from rock bottom, right? So you're there. In fact, we did a chart for our team about, what happens when consumer sentiment hits rock bottom. Well, it turns out the S&P tends to rally right after that. And we went back about 40 years with this. So, the soft data is not telling us anything that we don't know. But we're here. And, the concern really is that unless you start seeing the outlines of what a deal looks like with Japan, with the broad outlines, yes, details can take 6 months, 12 months. But what does it look like that would further remove left tail risk on the market? And I think here you're fairly priced. You're fairly priced at about 5,400 for where earnings are going.
8:30 Eastern Time, US retail sales. US retail sales for March. Is it too early to expect some weakness to show up in those figures?
Given the fact that the sentiment data was already cratering in March, if there's some read-through, you should start to see something going on. I find what's fascinating, actually, is the fact that tariff is on everybody's lips. The American public, which tends to tune out a lot of political stuff, is talking about tariffs everywhere. And so everybody knows about it and concerned about it. And of course, it's the inflationary piece that everybody's worried about because we just lived through bad inflation 2 years ago. And so that's the biggest fear here. But sales probably represent some pre-buying.
What do you need to see to try to get more confidence in some sort of risk rally? And I say this at a time where we do have a number of earnings that are coming out pretty positive. UBS's CIO came out with a list of 5 reasons why they actually are getting pretty positive for U.S. equities in a 6 to 12 months basis. And they include April tariff showers, May fiscal flowers. This is really fun. The Fed put and the data by U.S. exceptionalism, especially when it's on sale. That last point, do you think that the divergence between the U.S. and the rest of the world has been overplayed?
Totally. I think it's been totally overplayed. Meaning the rest of the world, we are the buyer for the rest of the world. We have the best consumer on earth. It's 70% of U.S. GDP. The consumer can be down, can take a break, but ultimately this is what drives the global economy. And if there is concern about where U.S. policy is going, well, boy, the rest of the world really has an issue here. That doesn't mean the rest of the world can't outperform this year in some sort of catch-up trade as some of the heat from the tech sector comes out on the multiples and the S&P resets here. That's perfectly reasonable. But if you look forward for the cycle where this is going, I struggle to accept the fact that the rest of the world will be growing faster than the U.S.
At the same time, people talk about the response to tariffs from the U.S. and it comes to fiscal spending. You've seen that in the U.S., you've seen that in Europe, you've seen that in Japan, you've seen that in China. Why can't you just follow the fiscal spending at a time when a lot of people are saying that tariffs tariffs will hurt the United States as much as some of these other trading partners.
So the fiscal spend is a great story as a trade. In the end, we do long-term wealth creation, we do long-term wealth preservation. So that for us would represent, a nice trade for the next 12 months. That's probably the right framework to look at it. But if you look at how the markets have performed since Liberation Day, actually the U.S. has outperformed the rest of the world, with the understanding that the U.S. is actually in a better position here than the rest of the world, specifically on the trade issue. So fiscal can only get you so far, as we've seen in the U.S. You can prop up the economy for a couple of years, and then you really have to deal with the underlying productivity and barriers to growth that you have, for instance, in Europe, that you have to deal with. So they're going to put $1 trillion into the economy. How productive will that capital be, right? Where are the regulations going?
Trying to get some visibility on policy down in Washington, and now we've got legal issues. So if you're just joining us, I want to share this story with you again. The California Governor Gavin Newsom has said his state is suing to hold President Donald Trump's tariffs, citing harm to consumers and businesses. Harm to consumers and businesses. Now, this is something people have been talking about for a while. Is that enough to say you've got a legal footing to push forward and really stop what's happening here?
Well, I think given the fact that the United States, the administration has come out and said that this is due to IEEPA, a national security concern, that likely that will be upheld in court. And I think this is one of the things that Jamieson Greer, the USTR trade representative, has been very focused on, making sure that anything they come out with can legally be upheld in court. But the courts are going to fight it out, and certainly Governor Newsom, I think, eyeing maybe a 2028 bid, is going to do whatever he can to try to make this point very clear.
This is almost exactly what Libby Cantor of PIMCO said to you and I on Sunday evening. This is what she was anticipating, these kind of things, and this is the first, and I'm sure it won't be the last.
And this is ultimately the real question with exemptions. How much does that open up the Trump administration to legal challenges based on the fact that, is it a national emergency or not? There has been a lack of direction in terms of exactly why some of the tariffs have gone on, which might go to some of the legal fight. That said, even if they do get undermined, there are other provisions that this president can use to try to get these tariffs through. So again, the whack-a-mole of tariffs, it's not going to go away. It's just going to get dragged out in a court system.
Alicia, everyone's become an expert in trade relations, and now they need to become an expert in trade law. As an investor, how do you navigate this mess at the moment?
Really difficult. Really difficult. Look, I think with the VIX at 60 and the S&P hitting about 4,800, that's typically a signal to close your eyes and buy. Because your downside from 4,800 in the worst case scenario is probably a 4,400 or 45. Worst case scenario, like deep recession, earnings get cut to 230 or something like that, is probably a 44 to 4,500 from 4,800, and it's asymmetric risk to the upside there, particularly when VIX hits 60. So we're looking at technical analysis for that kind of thing. The 200-week moving average on the S&P, which is held for about 50 years, is at 4,600. So 4,800, you've essentially de-risked it. The only time the S&P went below the 200-week moving average was during the depths of the global financial crisis. And then it popped right, and every crisis, you just hit it if it's bad enough, and you respond from there. So that's what we're looking at. Here at 5,400, again, where we think earnings are going, which, it'll come down over the street, you're probably fairly priced for now for the kinds of uncertainty, very difficult to model. I think it's really good to remember, though, there's also right tail risk. We all sit here and talk about the left tail risk. We can't model it. It's a terrible policy. It's inflationary. It's stagflationary. We're going to go into a deep recession. But there's also the right tail. And I think in markets, there's always a two-way trade. And I think now you're starting to get the conversation about, okay, what could the upside look like? And I think we need to remember it.
I'm glad you mentioned the VIX, because the Treasury Secretary mentioned the VIX in my interview on Monday, and he said it's likely peaked and it spiked. Do you agree with him? We're past it, or you think we could see the VIX spike again?
On a probability basis, we've probably spiked. There can't be any certainties here. What I do know, when the market's down about 20% and the VIX is at 60, I have better odds than not in deploying capital at that point. And so that's what I would say. I'd say the real risk here is there some kind of financial contagion, right? Where the bond market and the FX market have moved so quickly, acting like the equity market, frankly. What's out there that we're not seeing that's leverage that could create a broader financial risk. If this is a policy-induced error and a policy-induced sell-off, those can be fairly quick. Maybe you have a bit of a U-shaped recovery, but more or less we're intact. The issue is if this becomes a financial contagion. So yes, VIX at 60 should be a buy signal. The S&P at 4,800, more risk, to the upside than downside, still downside risk, but your asymmetric risk. It's really the financial contagion issue. We don't know. We don't know. That's what we have to think about.
Let's get to this. If you don't know how long talks are going to last, what do you do in between? We keep hearing this phrase, wait and see. What kind of CapEx decisions can you make in the meantime?
So we're very concerned about that because already intentions to invest and intentions for CapEx have dropped. If you look at all the survey data, that's what we're seeing. So it's a pretty brutal policy in terms of forward investment. And that's really where the problem is coming, that each day that this goes on and time is just not on the side for the real economy, just as a reminder, the market always bottoms before the real economy does. It happened in COVID. It happens all the time. It's just to remember that that's out there. But there is real damage happening today, right now. It's great that China and the U.S. are negotiating, but it's impossible to make a decision if you're a COO or a CFO where to put investment. It's impossible. And so I'm concerned that you might have a freezing in the real economy here. I think the risk is real, and I think it's happening right now. And certainly the damages to small businesses are beyond, right? So the interesting thing, the challenge from the governor in California is really the first major IEEPA challenge that we've seen since policy was announced on April 2nd. So it's actually amazing that there haven't been more. It hasn't been immediate, but I think the administration knows that IEEPA is a little bit more on shaky ground, which is why they're putting pharmaceuticals and semis under 232, right?
There's this other question. It's not just how this trickles out into the actual economy. Are there certain sectors that are going to be so exposed so as to be not really desirable for you? I'm thinking of auto manufacturers or retailers.
Yeah, look, but for that, in terms of an investment thesis, you just really have to look at how far the stocks have fallen and where the multiples are. Because there is a price at which you pay because it's been completely de-risked. So the auto sector looks like it's been completely de-risked here. The market's very efficient in pricing it with the worst case scenarios, and I think we have it. Again, we have to remember the markets always bottom before the real economy does. So sentiment data has been rock bottom really for about 5 or 6 weeks now. Again, the American public knows the word tariff, which I find fascinating because sometimes they don't know who the defense secretary is. And so we've seen the sentiment data really be terrible. The issue is, can the hard data at this point declining do more damage to markets than what we're already anticipating? And as investors, that's where we have to live. We've gone neutral on equities. We've moved some of the allocation to short-term fixed simply because we too are really uncertain. It's very hard to have conviction except on price and valuations.
President Biden forgot who the defense secretary was once upon a time. Do you remember when we lost him for about a week?
He was lost because he was under anesthesia. Yeah, that's right. And then he didn't call the White House to tell them he was going to be under anesthesia. So yeah, I think it was 24, 48 hours.
Is that how long it was?
We lost the defense secretary.
Got to find space for jokes here, Bramo. Alicia Levine of BNY Wealth. Alicia, it's good to see you. Rieder of BlackRock writing, taking opportunistic positions in good quality companies in the equity market has and should continue to pay off for investors with longer time horizons. I'm pleased to say that Rick joins us now for more. Rick Rieder, it's been too long, my friend. Let's get straight to it. I just want to understand what you've been seeing with the team over the last week or so. Have the foreign buyers of treasuries been pulling back?
So, I mean, boy, it's been an incredible period. I mean, so, to start with, I mean, the Treasury market, the move back in the Treasury Friday was extraordinary. This pressure on the Treasury market, concern about international selling, that was pretty amazing. And then we bounced back pretty nicely as some calm has come back in. And then, the volatility in the equity market, the daily volatility, a little bit calmer this week. Does present, similar to what I said there before, it does present some opportunity in these markets. It is, I will tell you, the uncertainty, though, has led to liquidity in these markets that's pretty rough right now. When you go to execute, you got to be very thoughtful and very tactical about how you do it, because markets are very jumpy and very uncertain these days.
And Rick, typically the place you go for liquidity is the Treasury market. Deep, predictable. That's why people buy Treasuries. Rick, can I get your view on what you think was happening last week? Do you believe that was foreigners pulling back? Is there a question mark over the US safe haven status? Or is that just certain trades unwinding, things blowing up?
It's a great question. I mean, so first of all, when you have this pressure on the currency market, and by the way, it's super acute when you think about equities going down the same time that the currency is going down. Usually the dollar appreciates when you're in this risk-off mode. So you've unquestionably seen the pressure on equities and international disposition of the equity of a number of U.S. equities. In the rates market, it's a bit more blurred, but there's no question about it. There is some concern. We fund so much of our Treasury debt internationally. There is some concern with the currency depreciating. And then, quite frankly, the back end of the curve going through these periods of spasm where inflation is higher. Even if the Fed cuts, what does it do for the back end? There's an argument that when the Fed cuts, the back end becomes less tethered, and in fact, you get a steepening of the curve. So, yes, I think there's some international disposition for sure as the currency weakens. But I think broadly, it's this uncertainty, and it's just hard. You watch days like Friday. It's just hard stepping in, particularly in the back end with this uncertainty still out there.
So, Rick, at what point would you step in?
So I like owning the belly of the yield curve, and I like owning, the front end has gotten pretty well priced. I mean, you've got to, and I think the way you all described it, the Fed, you're pricing in an awful lot of cuts for the Fed this year, and you haven't seen that hard data deterioration. I do think you'll see that in labor over the next 2 or 3 months. You'll see some pullback of probably some significance in places like healthcare and education, leisure and hospitality, but we've got to see it. But the belly of the yield curve, there are some opportunities. And quite frankly, Europe is more interesting because you don't have the inflation impact in Europe. The ECB's got to cut more aggressively. So I actually think, we've seen some real opportunity. It's actually European rates. Very different. And by the way, you don't have the international disposition there. In fact, that's where you have, it's probably international, I'm sure, you have international buying. So European rates is a place recently we've liked quite a bit.
Can we take this a step further? You talk about how U.S. Treasury markets tend to be the deepest, most liquid, and then you talk about how rocky liquidity has been and how execution risk has become an increasing consideration for you. Have we gotten to the point where on some of these days, the European rates market has actually been more liquid than the U.S. rates market?
Good question. I mean, so more liquid, I don't know if more, certainly the back end of the yield curve, it takes price to get execution. I don't know if it's more liquid. It certainly feels to me like you have this ballast of, you've got an ECB moving, you've got a yield curve that's already pretty steep in Europe. And by the way, if you're a dollar investor, you get a cross-currency swap benefit. And because the curve's so steep, you roll down. So, there are a lot of reasons why I'm sure others, as well as ourselves, have felt like, gosh, it's a safer place to be, even though you're going to get European funding of fiscal initiatives over the next couple of years. That just takes some time. But I don't, I still say the Treasury market generally is much deeper. But Europe, you definitely see more buyers coming in internationally as well as what we see in the States.
Rick, it seems like the picture that you're painting is a regime change. The picture that you're painting is shifting away from the United States and following a real flood of money into some of the overseas markets and frankly not betting that the long end of the yield curve will provide the ballast that it has in the past. Can you talk about what else has changed? Does this really undermine or reshape the way you look at 60-40 or the position of gold in your portfolio?
It's a great discussion. That's a long discussion. A ton has changed. Like you say, we've added in the portfolios, not in our fixed income, but other portfolios, we've added gold. We think gold is a good hedge generally. Quite frankly, you have to, during periods like this, you tactically hold more cash in the portfolios. We've done that. Back end of the yield curve and interest rates and as a hedge when you've got inflation moving potentially significantly higher, not really a big benefit to the portfolio. So, and then the other one, when you get rates backing up, you can get your yield much more attractively using high quality assets. So even though some pressure on parts of the high yield market, pressures in the lev loan market, you can actually still create them in one of our ETF, this BINC ETF. We're able to create over 7% yield and actually improve the quality of portfolio, run more cash. That becomes super attractive. As long as you're not stretching, go down the credit structure into the triple C rated high yield, you can actually create more yield today. So I like the idea, build some more cash, use some tools that are different than in the past, and then, quite frankly, just get higher quality and more liquidity in the portfolio.
Rick, do you think the rhetoric around the fact that some investors are saying they're dumping dollars, dumping treasuries, that the U.S. is losing safe haven reserve asset level, do you think that rhetoric is overblown?
I'd say sentiment can change really quickly. I mean, we're in this period now where there's clearly a concern about the currency, and there's clearly a concern about how do we bring the debt down, how do we get interest rates down. So I'd say near term, there is a question. Listen, I think reserve currency status is something that is absolutely critical to the United States. We fund a lot of debt globally. The number of the percentage of trades in the world that happen in dollars, bills as a collateral for many of the transactions in the world. I think reserve currency status is absolutely critical. Are you denting it? You're definitely denting it. And listen, I think this year is going to change. I think we've got a couple of months here where there's a lot of uncertainty. You got an economy that's probably in recession today in terms of certainly where corporate spend will be. But I think as you get into the back half of the year, things can really evolve. So listen, I think you're chipping away at reserve currency, but I don't think there's a natural alternative. So, I think things can change. Hopefully they do.
Rick, hopefully they do. But that last point there I think is important. If we are in recession today, do you think risk assets are appropriately priced for that scenario?
So I would say today, listen, I think the tail has gotten fatter. I think quality assets, they're pretty reasonable. There's a lot of quality assets we've been adding to agency mortgages, et cetera. Listen, I think you've got to put a wider range on the equity market today than you've had before. You've got an economy that's pretty uncertain. And you've got to, I think you got to keep your beta a bit more restrained today. Quite frankly, one of the most interesting trades in the last couple of weeks has been to sell puts, not to necessarily increase, but, the best time to sell insurance is after a hurricane. And there have been some great trades actually sell downside where, gosh, if we go down another 10, 15, 20, depending on single name, go down 10, 15, 20%. You get paid handsomely for taking that. So keep your beta restrained, hunker down a bit in terms of risk, but then find some place like, gosh, I would add if we came down, if markets went down significantly. So anyway, there are a bunch of things to do in this market, but I just think you have to expand where you think your return objectives are going to be and the probability around it in an environment like this.
Things have changed a lot. Rick, it's good to see you, as always. Rick Rieder of BlackRock there. Rick, thank you, sir. We'll do it again soon. Wall Street's biggest banks looking for some clarity on policy. JP Morgan's Jamie Dimon urging Trump to start talks with China and telling the FT, quote, "We should be careful. I don't think anyone should assume they have a divine right to success and therefore don't worry about it." Joining us now to discuss, the former Republican House Majority Leader, Eric Cantor. Eric, welcome to the program, sir. Welcome back. It's good to see you.
Nice to be here, Jonathan.
Let's reset. What do you make of the approach from the administration to trade over the last few weeks?
Well, listen, I mean, there are so many, there's so much noise, so many signals coming from the White House right now. I think that market players are just, sort of trying to take a step back and figure out if they have a portfolio of companies, what it is that they look like, if they're import sensitive. Obviously, there's now a little bit more focus on what's coming out every single day of the White House. I think the imperative for the president and his team today, as they're meeting with Japan, is to demonstrate success. I mean, this is where I think people are looking for some amount of clarity in that, what does it mean when we're supposed to be enduring some pain? And the president's been pretty clear, saying, hey, we're going to change sort of the trajectory of the country. We're going to strengthen the foundation. And if that's the case, what does it really look like when he's dealing with a counterparty? And if it's Japan, and I would say even India, because India is the one that is most protectionist that comes to mind. If we can demonstrate there's an opening up of that markets, that this is what it's all about, I think that would would calm some nerves right now.
Are you convinced that is the metric for success?
Well, I think, there is, Alicia, you talked about sort of taking him literally, taking him seriously, or hinted at that in what you just said. And I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here. So, Jonathan, back to your question, if he's about trade deficits, because that's been one of the real metrics that he's put out there consistently, that's what it's about. So who are we going to see the Japanese buying more of our goods? Are we going to see that along with the opening up of their markets so that our exports can flow into these other countries?
The president ran, though, on getting everyday goods down in prices, things like groceries, things like gas. A recent CBS poll says a majority of Americans see tariffs adding to prices, adding to inflation. Can they wrap this up before the midterms?
Well, this is and then this brings up the last point I think that's really important about today, and when we look at Capitol Hill when Congress gets back. I think the administration and the Republicans need to act with dispatch. It's important that there is some success under the belt demonstrably, so the markets see that in terms of dealing with countries. And I think from the Republican standpoint in Congress, they've got to get this reconciliation bill done. Simplicity is their friend right now. Adding additional taxes, doing those kinds of things is going to take weeks, if not months, to bring everyone on board. And I think if we can just extend what President Trump had said was the greatest tax bill ever, 2017, they should just go ahead and do that.
If I had said to you, Congress right now is debating whether or not to raise taxes on people that make $1 million a year, would you think that came from a Republican or a Democrat?
It is an extraordinary concept coming out of what I believe is still a very pro-growth party. I think you've been discussing this morning, the three legs of the stool of the Trump economic plan. One of them is taxes, the other deregulation, along with the trade agenda. All that has to come together to help growth in this country, to see incomes rise, wages, growth, wealth, all of it, opportunity. And to sit here and say that we are going to be increasing marginal rates on individuals, that ends up hurting small businesses. I mean, that's the trick there. When they start talking about millionaires, remember, we've got a lot of people in this country that file taxes that have sub-S or LPs or that are taxed at the individual level, but actually run businesses. And I don't think they're going to get too far with that concept.
But what if they do? This is a pillar of conservative orthodoxy, not to raise taxes, period, on anyone. What do you make of the party and the direction of travel if they were to go ahead with this?
Well, again, I'm not sure that they're going to go ahead with this.
But they're discussing it right now.
Well, I'm not so sure how widespread that discussion is and what kind of enthusiasm there is. But this is not a pro-growth item. And I think more of the focus is going to be on how they come together on these pay-fors, because we saw, again, the important data point that occurred last week was the bond markets. You know, we saw the concern there about the fiscal health going forward. And I think it's really important they focus on that so they can act with dispatch and get these tax rates extended.
Heading into this year, the belief was that President Trump was going to be a pro-business president who was going to focus on fiscal responsibility as well as celebrating national champions. We have seen policies that have reaped the opposite consequences in markets. Do you think that this president is still pro-growth?
I do think he's a business guy. I mean, we all know he's a real estate developer from New York City that was very successful and had times here where, just like any in the real estate business, there are ups and downs. But he has demonstrated the ability in business to create wealth, and I think he wants to do that for America. And so, yes, I think he is. Now, what he's going about doing in reordering our economy and trying to sort of rebalance, if you will, the balance of trade, as well as the burden sharing that occurs with us and our allies, importantly in the financial realm as well as the defense realm.
Although you have a unique position because you wear the hat of both being in government in a leadership position and also talking with tons of companies while being vice chair of Moelis. do they have the confidence to invest? Do they feel like they can be expanding right now and have confidence and conviction that ultimately this whole mix will benefit where they're heading?
Well, I mean, I would say, first of all, we're still America, right? I mean, there is still this unbelievable country that we've got with, and we can go through the various aspects of what draws capital and investors here, rule of law, transparency, you name it, innovation, the rest. We're still that. The Trump administration understands, and the president in particular has said the biggest asset we've got is this huge consumer market that the world now has tooled up to take advantage of. And he's trying to use that to go in and create a more stable trajectory longer term, both from a fiscal and economic standpoint. So I think, listen, right now as we started, there's a lot of signals that are creating this sort of question on the minds of individuals, whether they are strategics, whether they are sponsors, and how to go about in terms of conducting their business. And that's why I say, again, really, really important that we see manifestation of success. The president's really good at communicating. I hope we can see some communication of success and that people will begin to understand what the trade-off here is.
This is ambitious stuff. Let's finish on this. Governor Juncker was in your seat yesterday, and we asked him this question. I'll phrase it differently. At the moment, there are two very left-wing politicians in this country filling stadiums, getting support, at a time when the Democratic Party is an absolute mess and support is rock bottom. I get that. But do you worry that if the president isn't successful, that in a number of years' time, this pendulum could swing aggressively to the left? If the right can't provide the solutions, does this country seek out solutions from the left?
Look, all I know is the left is so in tatters, and the one pillar that they've got of any kind of unity is so extreme on the cultural side and the design of where they see the world. There is no way that the mass of this country in terms of an electorate is going to adhere to that extreme Bernie Sanders AOC agenda. There is just no way. Now, not to say that there will be unhappiness if we don't see success, again, which is why I come back to the point it's important that we act with, that we see some urgency and acting with dispatch in Washington.
Because you understand the risk here. To bring up the EM example, that you swing between Bolsonaro and Lula, and you start to resemble what we see in Latin America repeatedly.
We are America. We are America. We are not Brazil, right? So we have a long tradition of continued institutional guardrails, protections. We have the deepest, broadest capital markets there are. I still believe that we can get through this. Again, as you said, this is a very ambitious goal that the president has set out to sort of rebalance. It is where we can head, and the fact that there have been some people left out.
Yeah.
And when you talk about these stadiums that are filled by Bernie Sanders and AOC acolytes, it is those people that are looking for the answers, and frankly, a lot of sort of people who feel left out, if they're at those stadiums, they are looking to the president to deliver on the promises that he's made.
It's an ambitious agenda. We've said it repeatedly on this program for the good of the country. We hope he's successful. Eric, it's good to see you. Thanks for dropping by. The former House Majority Leader there, Eric Cantor. The United Airlines CEO, Scott Kirby. Scott, welcome back to the program, sir. It's good to catch up with you once again. Let me just understand maybe your approach to this earnings report, how you and the team decided, you know what, this time I think we have to do something different and offer a dual forecast. Where did that come from, Scott?
Yeah, we did. We thought it was appropriate to do something different. It starts with, the environment has gotten more difficult. But first, we did have, as you said in the intro, the best margins we had in 5 years. We grew margins year over year. One of only 2 airlines that are profitable. And as we kind of went through it, we still see a viable path to getting to as long as bookings remain stable as they are today, to getting to our original guidance. But we also recognize that there's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like if it happens here at United. United. So really the goal was to just give investors more information. It's non-traditional. We're the first ones that I ever know of that have done something like this, and so far the feedback has been really positive, and I think investors and others appreciate that we try to give them a more fulsome range as we gave guidance this time.
Scott, can you give us a sense if you were catering more to investor nervousness or whether you were responding to actual weakness that you see in some of the forward bookings by clients?
So I'm guessing you're referring to our capacity changes, and we're going to pull about 4 points of capacity from the second half of this year. That's really just a pure tactical economic decision. We do see weakness, and because we see weakness, it means we're starting to cancel some of the utilization flying. That red-eye flight that was barely profitable in really peak strong times becomes unprofitable when the demand environment weakens a little bit. Customers have more choice to fly at better times a day, and so they do. And so all we're really doing tactically is pulling some of that marginal flying, marginal in good times, turns negative in bad times, so we're just pulling that out of the system.
How much do you see going forward, though, any kind of retrenchment from consumers whatsoever? A lot of people have been talking about how particularly international travel is going to come down with people from overseas not coming to the U.S. Are you seeing that in forward bookings, or has that kind of been more of a narrative than a reality?
It's been more of a narrative than a reality. We saw weakness starting kind of at the end of January. We saw a step down, but it has stabilized in March, and even the first 2 weeks of April, it has stabilized. And the weakest area we see is actually the low-end domestic consumer here in the United States. International has remained quite strong. International, for what it's worth, is 82% U.S. point of sale, so it's much more dependent on the U.S. economy than foreigners coming to the United States. It's also less corporate than it used to be, and because of that, the leisure traveler is still going, the premium leisure is still there. Typically, even in times of economic weakness, the high-end consumer outperforms, and that's what we thought would happen. That's what we've seen so far. We'll keep watching it, of course, but that's certainly what we've seen so far.
How much does this really put you in a position to consolidate market share? Right now, we keep seeing that among a lot of the leaders in different industries, that this is time for them to compete on price, to compete on some of the offerings, and frankly squeeze some of the other weaker players in the market so that you emerge on the other side a lot stronger. Do you see that happening with United right now?
Well, United, we've had a 5-year strategy to win brand loyal customers, and we've done that. So really nothing is changing United. We're not doing anything incremental, anything different. We're continuing the path that we have been on because it's worked. It's led to the best margins in good times. I think that lead is going to expand in tough times, not because we're doing anything special, but just because we'll have more seats to sell available to those customers. And when you're the brand loyal airline, when times get tough and you have more seats to sell, more customers migrate to you. And so we'll wind up selling more seats at lower prices because that's the way our yield management system works. But we'll sell just as many seats, but it's going to make it much harder at the bottom of the customer choice pyramid.
Scott, as you know, there's a lot of tension right now between the United States and China. That's been expressed in several rounds of tariffs from either side. We hope they can come to the table and have some talks, but so far, not great. For the maintenance of your plane, sir, and the exposure that you have to China, to Hong Kong, how are you managing that situation at the moment?
At United, we have more of our heavy maintenance work done here in the United States than any airline in the country. We've been growing here in the U.S. In fact, over a 3-year period, we're going to hire about 5,000 maintenance technicians here in the United States, building huge new facilities in Houston and in Orlando, and most of our work is done in the free trade zone outside of Hong Kong, the work that is done in China. So we're monitoring it day by day, but we have a high percentage here in the United States, more than anyone else, and feel good about our setup.
Scott, some CEOs have been quite outspoken about what they'd like to see from the administration on policy. Are you willing to do that? Is there a reason why maybe you'd be a little bit more hesitant to weigh in?
Well, I've spent a lot of time in D.C. This year, as I always do, but I've mostly been focused on listening instead of talking. And so I wanted to understand where the administration was coming from, what their goals were, how they were trying to get there. And I actually by the end of March, felt like I had a pretty good understanding of that. And if you have that kind of understanding and you can put everything that's happening into context, it makes it a lot easier to manage the business, to not make panicky decisions. And what I think is happening here is, we're nowhere near the end game yet. These are still the opening moves of the chess game. And I think I and most people that I talk to, or things have slowed down, but we're all in a kind of a take a breath mode. And let's wait till we get to whatever the new normal is going to be before we start making big long-term decisions.
We've all got to take a deep breath. Your stock is up this morning by about 6.5%. I wanted to talk about something with you that we've been talking about for a while on this program. Scott, as you know, one of the most disruptive parts of flying right now is the boarding process. And when you get on, everyone is wrestling to find space to put their bag over their seat. How do we address that situation, Scott? Because I can tell you as a traveller, it is the most annoying experience, and it's not unique to United. It's something we're seeing across the board.
As a father of 7, I understand it, trying to get on with a bunch of kids. And I'd say we're fixing that at United. The biggest thing we can do, we had to put bigger bins on the airplane. We're over 50% through the fleet at United, but we're putting bins on all the airplanes that are large enough that on a 100% full airplane, every single customer can bring a rollerboard on and put it in the overhead. And I think that at its core is how we're going to solve it.
Scott, how much more can you get people to pay for things that they used to know they could get? I know that Frontier used to do that with cans of soda, and then they had to backtrack, or checking bags. Are there other things that you can monetize, or does it really come down to the credit card business, the loyalty program, counting on the front of the cabin?
At United, actually, we're kind of going the opposite direction. We have disaggregated the product. Give customers what they want. If you want the premium product, you can get it. You can go the regular economy product all the way down to basic economy. But, we got Starlink coming next year. We're going to have the fastest Wi-Fi in the sky, and that's going to be free for our customers. So Wi-Fi is going to be free, and it's going to be by far the best experience, the most bandwidth, the fastest speeds for any customers. And, in a lot of ways, increasingly, instead of being an airline that also has a loyalty business, we are becoming a loyalty business that runs an airline. I mean, being able to get customers to Tahiti and Cape Town, that's the cool, sexy reward that you get in the loyalty program. But, the large airlines, particularly like United, we really have the best, the deepest loyalty program. When I talked earlier about brand loyal customers, like customers that want to fly United Airlines. And that is the strength. That's what's given us the resilience to have strong earnings, even in a tough macro environment. It's what's going to let us outperform even if the economy gets weaker from here. That loyalty of customers, whether you call it the loyalty business or just having brand loyal customers, is the foundation that's letting United outperform.
A masterclass in communications from the firm in the last 24 hours. Scott, appreciate your time. Thank you. Scott Kirby there, the United Airlines CEO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.